We've got two eminent experts with us. Indranil Sen Gupta, Chief Economist at Bank of America Merrill Lynch, joins us right now on the show to speak about that as well. As is Ajay Mahajan, founder and CEO of FICC Capital. He joins us right now on as well. Thanks so much, gentlemen, for joining in. Ajay, to you first. And the obvious question, 6.7%. You think this is the top, so to say, when we use a technical parlance out here. But do you think we've reached the top, so to say, in Q4 and maybe the quarters ahead could be better than what we've seen?
Yes, possibly. I think if you ask on a relative basis, we possibly have seen the top, partly driven by, I guess, a surge in imports during the third quarter of the year around the festival time of Diwali, a lot of gold imports and so on and so forth. So generally speaking, 6.7% is clearly not what we are expecting anyway the full year to end at. With the averages of the other quarters, especially the last quarter of this year, we're expecting a number of more like 5 to 5.1 for the whole year. So certainly 6.7 seems an odd number out, but nevertheless that's the reality, and the markets could potentially react in the short term to that negative number.
Indranil, wanted to get in your opinion on the same 6.7%. Were you surprised, and do you think that the next quarter could hold a positive number for us?
Yeah, the current account deficit came in at $32.6 billion, which is broadly in line with our own forecast of $31 billion. And we think that, the numbers will improve in the fourth quarter because I think, number one, you always have a seasonal improvement in the fourth quarter.
But Indranil, so the question really is going forward, could these numbers for full year FY13 and FY14, could it be much better than FY13?
We are looking at 5.1% of GDP current account deficit for FY13. In FY14, we are looking at 4.3%.
So Ajay, would like to garner your opinion on the same. Do you think that for the coming quarters we are likely to see elevated levels, or in just specifically for the next quarter itself, do you think that we'll see a sharp reversal?
Well, I think it's firstly, it's all expectations. We are all expecting, I think the market is broadly expecting next year the CAD to be lower than this year for sure. So the numbers vary between 4 to 4.5. We are more on the 4.5% side. However, the concern remains, what brings the CAD down, and that's a difficult question to answer. To specifically answer your question on what happens the next quarter, considering that April to June quarters generally speaking is low on growth, and as commented, seasonal factors usually in the first half of the year usually point towards lower growth, lower offtake from the bank credit system and so on and so forth. The chances of CAD being somewhat in control in the first 3 months or 4 months of the fiscal are obviously bright. But the bigger issue to me is, what brings this number, sustainably down over the long course, considering that the composition of these reserves is certainly, deteriorating. The short-term debt composition of the total reserves as a percentage of total reserves is now pushing numbers of 35-40%, and as a percentage of total external liabilities is about 25%. So the numbers are actually, it's not so much the balancing of the numbers and the balance of payments being, in general, all right. The question simply is, that the underlying characteristics of the economy with a very wide trade deficit and reducing invisibles, and more importantly, increasing outflows on investment income are certainly pointing towards some major structural changings happening to the CAD, which need to be very seriously addressed, both from a short-term and medium-term standpoint.
The other question would be what it does to flows, what it does to the currency as well. And Indranil, you've mentioned that the rupee is likely to remain in the range of 52 to 56. It's a broad range, but there's a risk of the rupee falling beyond 56 as well, at least some people believe, and that could happen towards the end of the year.
If the dollar trades between 120s a euro to 130s a euro, the rupee should hold the current range. I mean, if the dollar goes beyond that range in either direction, you will naturally see an impact on the rupee. But that is not our house view.
So then, Indranil, what do you think would be the key global risk to India's foreign inflows in your view on the overall foreign inflows for the rest of the year?
Given that there is sufficient global liquidity, India will continue to get its due share of foreign inflows. The economy is bottoming, and that's a source of support. But clearly, as we go forward, the political uncertainty will become a determinant of how much of capital flows we get, especially towards the second half of the year.
Ajay, I wanted to dwell on that point with respect to the rupee, because it's not just the fiscal deficit. We're grappling with the current account deficit, slowing growth, sticky inflation. All of these factors are going to weigh heavily on the rupee. In the long term, where do you see it headed vis-a-vis the greenback?
Well, my view is somewhat different. I think, in the wake of the last sort of 6-8 months of generally risk on globally, we have seen a fairly stable rupee, after the initial round of weakness that we experienced. We have seen stable rupee for two reasons to my mind. One, Indian rupee had already, substantially weakened against other currencies, and therefore, as has been pointed out, the equity markets improvement and overall portfolio flows from offshore, strong global liquidity, backed rupee strength in the short term. And I think the second point is again linked to the fact that globally interest rates have been so low, and Indian both fixed income and equity markets showed a promise. So from that point of view, the flows have been very good. Now the worry that I have is globally there's a chance of risk aversion increasing. I mean, we are seeing threats of North Korea now. Now I'm not possibly saying that we go to war immediately, but these are serious risks that are now emanating. There are tensions in the Middle East. There is and these geopolitical tensions definitely result in oil prices getting pressured. If you watch how the NYMEX WTI crude is doing, after seeing levels of almost $91, it's now trading 97. And Brent came off to about 105, 106. It's now back at 110 around levels. So chances are that if global pressures, increase, there is a bout of risk aversion. US dollar strengthens from here sharply, and the 31st March calendar year, or rather the fiscal year, is now over. At the end of the fiscal year, typically you see a lot of inward remittances and FDI proposals expiring. So you have a bout of inflows. My sense is that, with some of this slowdown and global risk aversion, you could actually see rupee weaken quite sharply from here on the back of very poor CAD numbers, and more importantly, lack of long-term, medium and long-term measures, being followed to arrest this decline on CAD.
But so that's the question really, Ajay. I mean, some valid points you've mentioned. Some of the points that the government has done itself, I mean, the FI debt limits as well, and there have been conflicting points on how effective it could be over the medium term as well. There's a lot of things being done for the short term.
Sure.
With the crisis situation that you mentioned, you think these short-term measures could actually help arrest that inflow problem and therefore the rupee as well, or you don't think that will be effective?
Well, I think the short-term problems have actually, while it has helped in us managing a square balance of payments position despite such a wide current account deficit, my view unfortunately remains negative, that these measures have really not, helped in increasing our ability to withstand a currency shock. Our composition of reserves, or rather our composition of external liabilities is worsening towards the short term, like I mentioned briefly earlier, and that is a sign of worry. So what should be done at the central bank and the government level to reduce the reliance on short-term debt? Obviously in the short term you need to balance your payments, so I'm not saying that we should not increase and widen our short-term limits on FII flows, but the fact is that's hot money, and that will retire soon. And when it retires, it poses pressure on the reserves. So therefore, in the medium to long term, I don't see any reason for us to feel comfortable with the $270 billion cash reserves position against an external liability of $375 billion. In other words, what I'm saying is that we need to improve our reserves position. Our reserves position is not, the cover of reserves to external liabilities has been declining steadily. Even at 70-75%, that number is not bad, but that number needs to improve, which means that even for the short-term risk of rupee weakening, the central bank at some stage would probably have to come into the market and start looking at improving the reserves, foreign exchange reserves, and improving the cover, which will give confidence at a time of weakness when the currency, if at all, comes under a speculative attack.
Thanks very much, Ajay, as well as Indranil, for taking time out and joining in with your overall opinion on the current account deficit numbers.